Vale SA has been setting itself up as the perfect swing trade and as the perfect value investment, and this process has been happening since the start of January. Now, there is absolutely no guarantee that what I predict will actually happen, but if it does, you all might be getting an entry around the $12 mark and an exit just a couple of months later around the $18 mark. A 50% profit. And again, that swing trade is largely based upon fundamentals. So based on the true underlying value of Vale SA. Hopefully that grabbed your attention because we're starting off with a company overview. Real quickly, Vale is a massive player in the global raw material markets. Specifically, Vale is an enormous mining company. In fact, Vale scored number 4 on this 2021 top 10 mining companies in the world list. So they are in fact a significant player. Now, what raw materials does Vale actually produce? Well, as we can see from the company's most recent Q4 2022 report, we can see that the company mainly sells iron in the form of fines, ROM or run of mine, and pellets. Aside from that, the company produces nickel and copper. Now they also sell gold as a byproduct, silver as a byproduct, PGMs or platinum groups, and cobalt all as byproducts. In my opinion, the main materials we should focus on are iron, nickel and copper. The rest doesn't really matter. Now, as far as how large each individual business unit is, during 2022, Vale's iron ore business was responsible for about $20 billion in EBITDA. EBITDA, of course, stands for earnings before interest, taxes, depreciation, and amortization. EBITDA might sound really scary, but it's just a way to express operational profitability. So basically, it's just how profitable your business is without taking into account the taxes, interest on your debt, and other non-cash expenses. Cool, so iron ore was responsible for almost $20 billion in EBITDA during 2022, while nickel and copper combined were responsible for less than $2.5 billion US. So as Vale currently is, Iron Solutions is by far the largest driver of revenues and profits. But of course, that is how the company currently is. Are we expecting a shift in its ratio between iron, nickel and copper? Well, for that, we have to look at the company's growth plans. Regarding iron ore production, the company does expect to expand production with about 20% up until 2026, which is certainly nothing to sneeze at. Now, the company does expect to grow its nickel production with about 30% over the exact same time frame, but the biggest growth by far is expected in copper. The company plans to grow this division in excess of 50% over that same 2026 time frame. Keep in mind, even with all this growth, iron will by far still remain the largest component of revenues and profits for Vale. But I believe that to be fine. Iron is a material which we as a species will continue to use. After all, iron is the main input for all alloys called steel. And steel is of course used in almost anything we humans build. And iron even has different use cases, for example in a lithium iron phosphate battery. That is to say, it is almost a guarantee we will continue to use iron as a human species. Therefore, I believe Vale focusing heavily on iron in and of itself isn't necessarily a risk. Now, 2 more things I want to discuss regarding Vale as a business. Number 1, its competitive advantages, which are paramount to operate profitably as a business, and second, Vale's current financial situation. Now, the competitive advantage of any raw material producer should always be cost. How low are your costs compared to the competition? And shout out to my buddy Lars for helping me find these charts. You are a true legend, mate. Anyways, this is the cost curve for all major global iron ore producers. The lower your company places on this cost curve, the better. After all, lower cost equals more profits, and more profits are always a good thing. Now, on this chart, Vale is located right here in this beige kind of color block. This is really low on the cost curve, around the $40 mark, while a significant amount of their competitors are located to the right, so they have higher cost per ton. And I believe this right here is a serious competitive advantage. If you are one of the lowest cost producers of a raw material, odds are you will almost never be forced to sell for a loss. While if you're this red mad lad located right here, you are actually already being forced to sell at a loss at the current price of iron ore. Okay, so that was iron. Again, Phil's biggest asset. Regarding copper, Phil actually appears twice on this list. First located right here with their Salabo property. This is the main copper property for Phil, and this is the one we expect to grow significantly in the future. Now, their second appearance was somewhere up higher on this cost curve, but honestly I forgot the name of the property and I can't really find the name again. Stupid from my side, but their property was located somewhere around here. So basically, Phil's biggest copper property also scores really low on the cost curve. And Phil as a business is mega low on the iron ore cost curve. That is to say, I believe this company has serious competitive advantages in the form of cost. Damn, this business is seriously starting to look super attractive to own. But there is one more area we should be looking for major red flags. And that is the company's balance sheet. We will be going through this quite quickly for the video's basis sake. We are seeing a significant cash position of $5 billion US. Very nice. Aside from that, the company does have more assets than it has liabilities. Always a good sign. Long-term debt isn't close to being a worrisome amount, as it can be covered in less than 1 year of profits. And the company's equity, which basically just means all assets minus all liabilities, comes in at about $37 billion US. So yeah, no major red flags from my side. And that was my overview of Phil as a business. I believe it's now time to start talking about why this company is setting itself up as such a nice swing trade and value investment at the same time. My valuation. I do highly recommend to do some calculations yourself as well. But here's what I've done to get to an intrinsic value for Phil today. Basically, I'm taking the company's production guidance for 2026. Specifically the lower end of their guidance. So I'm assuming 340 million tons of iron ore production, 230,000 tons of nickel and 390,000 tons of copper production. Regarding pricing, I'm taking the company's average realized prices during 2022 as a guideline. Now, I could be more conservative and apply a margin of safety to these prices to lower them, but I'm actually really bullish on almost all raw material prices. I believe almost all countries have been heavily underinvesting in mining companies for decades already. So taking Q4 2022 prices makes sense to me. You can always be more conservative if you wish. These amounts at these prices results in these amounts of revenues, which in turn results in a total revenue in 2026 of 42 billion US dollars. Now in 2022, the company achieved a net income margin of almost 38%. But you know, raw material prices have been acting crazily for a long while already. This is iron ore, by the way. But this really high profit margin might be unrepresentative going forward. Now, if we take a more conservative net income margin of 25%, we get to my future net income of $10 billion in 2026. If we assume the company has the exact same amount of shares today as it will in 2026, then that results in EPS or earnings per share of $2.3 by 2026. If we then slap on a price to earnings ratio of 12, which is quite doable for a raw material company, then we get to my 2026 price target of just shy of $28 per share. And basically what these calculations are telling us, Phil's stock price might double in less than 4 years' time. And $28 expressed in today's value at a discount rate of 15% results in my 2023 intrinsic value for Phil of $18 per share. So that's how I've come to that $18 price target in the intro of this video. But if the share price of Phil is $15 per share, how did I find that entry target of $12 per share? Well, that is where technical analysis comes in. Phil's been trading in this very predictable pattern since the start of 2021. If Phil continues trading in this pattern, we might just see $12 per share reasonably soon. As in a couple of months from now, soon. Perfect. Since based on the intrinsic value we just calculated, I would be hella down to be buying Phil for $12 per share. I do not really wish to buy Phil today at $15 per share, since there's just too little margin of safety. But I would certainly be willing to buy in around the $12 to $13 mark. So now it's just a game of patience. The question is, will Phil continue to trade in this very predictable manner? If so, I will certainly be scooping up some shares for the easiest swing trade and value investment of my life. And if the stock does decide to break this trend instead, I'll be looking for better and different opportunities elsewhere. That's the best part of investing. Nobody is forcing you to swing your bet. You can always wait for a better pitch. And maybe, just maybe, Phil will become that perfect pitch in just a couple of months from now. Time will tell. Now, time for a classic YouTuber disclaimer. While I am a registered financial advisor in the Netherlands, I do not have the legal capacity yet to give anyone investment advice. Therefore, this video and any other video on this YouTube channel can never be taken as financial advice. I cannot be held liable for the losses you make while trading according to my opinions. Please do your own due diligence. And with that said, thank you so much for watching. I love you all. Peace.